Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, April 2nd, 2024. It's 10:58 a.m. Eastern Time. I'm starting the video, so we're an hour and a half into the trading day, and just wanted to get an update out to you, show you, of course, some of the things I'm watching. I did get one out to you this morning regarding this. We'll start here because to me this is not everything, but the biggest thing right now, in my opinion, has been for months. You get almost nearly daily updates on my zones here on the 10-year Treasury bond. That's IEF. But I also want to cover and expand on what I did last week, towards the end of last week. I did, in a video, I laid it out very, very simply how I'm positioned. I tried to drive home the benefits of asset allocation. What's driving that, or what drove that, is just and again, I know it's a relatively small number of voices on there. I don't know if it represents more of the subscribers on this site, but just outright frustration, losses, outright anger, and it seems like some of those folks are only trading the stock market, and it's been a very unusual year. Last year was, I should say, to say the least, and then this quarter means 10% means nothing. I mean, 10% in a day or a couple days on a typical swing trade, and I'm talking about the market being up 10% first quarter. You would have, the cheerleading parade they marched out on, Bubble TV was just wow. For a whopping 10% in 3 months gain. But anyways, what I want to cover are the other things. So last week, I've just made it very clear, asset allocation, diversification, told you my, personally, and what we have long on the site, select commodities, such as wheat, corn. I'll get to all those in a second. I'll cover the charts. I'll hit on briefly natural gas, bearish equities, short equities, and then I'm going to go over, and I mentioned some sectors last week, so I want to expand and add a few more in this video. I'm going to cover, I'm talking about the semis forever, and the semis are just a story of the stock market and of the NASDAQ 100 and of tech, really. You have the stock market as a whole. Let's just say the S&P 500, very well diversified. They call it the broad index, the broad market. And then within that, the biggest sector by far, not even a close second, it's double the second largest sector. There's 11 altogether in the S&P 500 in tech at over 25%, dwarfs even the next largest, which is healthcare. So it's really all about tech. And then within tech, semis, I always say, are really the canary of the coal mine. Just kind of the engine that drives tech as a whole. I think we'll all agree on that. And of course, the poster child of all things AI, NVIDIA, is a semi. So anywho, this is that. I don't want to say much more. We're in there. We're in the green. We're in the orange zone. I told you this morning on that post, I'll be watching this. There's a potential here that this could be a whipsaw. Whipsaws are not just uncommon. They almost have to be expected in this market, in this day and age. I don't know if it's the algos. The biggest money out there in the world that drives the market is in the big banks. The Fed's made sure of that, years and years of the Fed just having the banks' backs and giving them what they need. And of course, Glass-Steagall being repealed in I think it was the early 90s, where separated the firewalls between banks and brokers. The same stuff that caused the Great Depression. That was all about the banks taking people's deposits and money and gaming the stock market with it. And then when the stock market blew up, the banks went bust, and we all know what happened. So of course, we're back to that again. And then, too big to fail used to be the too big to fail, the big mega banks. And then last year marked a historical precedent. Those regional banks that were never deemed too big to fail were all of a sudden deemed too big to fail. So we all know what happened there. And again, that's part of why last year was quirky. All right, but let's just talk on this. So we'll watch that. And it's a potential development. So, the way I operate, the way I trade, and I've been talking about this for a while, is, if we move back into the green zone, either not going to short or add to shorts or take new shorts. Not necessarily, but generally. And again, I talked about this one when we were poked our head back in the green zone last week as being likely to fail based on the technicals at the time. It wasn't, as I said in that video, it wasn't just a random hunch or my trying to will the stock market down. I just said, look, this is probably just a little brief pop. And that's what happened. So there's where we are. And will this be a whipsaw too? We'll see. If it is, there'll be shorts covering Treasury bonds that shorted this breakdown today, and there will be longs or bulls that will step in and buy that to take advantage of those short sellers covering, because remember, a short seller covering a position is buying a position. When you short a stock or a bond or whatever it is you don't own, you borrow someone else's is basically what you're doing from your broker, and then you got to buy it back to close out that position. So that's why short covering, and of course, longs are, look, I'm a trader. Traders are, in a sense, predators. We smell blood in the water. And to me, I don't care if it's a short squeeze. I want to be on the right side of that going long, or if it's a breakdown where it's opposite and reverse, where longs are piling out. And then I'll, take advantage of those stop loss order and sell orders getting hit by shorting something. But all right, let's not overthink it. But it is worth watching. There's been a snapback so far. Now, here's the thing, guys. I made it clear on the QQQ trade. I expected a reaction where I got out to this morning. I'm going to get to QQQ in a second. But I just wanted to say and reiterate what I often do. Support is support until unless broken. It was broken. And then resistance is resistance until unless broken. So I'm sorry to expand on that. Support once broken becomes resistance. So that's what I'm trying to get to here. Now that level, the bottom of the green zone is, or the yellow zone that is. This is the yellow zone right here, defined by 94.50 down to about 93.50. That now becomes resistance. That's how that works. So only a solid recovery, especially a big, solid 60-minute candle at minimum, if not a daily close well back in there, that would mean it then was a whipsaw up to that point. Alrighty, let's go to QQQ, and then I'll get to all the other stuff, the sectors I want to cover, and give you some trade ideas there. There's some new ones too, as well. QQQ, so that's the targets I've had here forever and a day. I keep calling that one 439, and I said likely get a reaction around that level. But I what I try to do my best is also convey my thoughts. Okay, is it a reaction worth even for swing traders to cover and game? I didn't think so. That's why I made clear, preference is to sit tight. Why? Well, because we're in that orange zone. And, exactly what I said predicted would happen has happened. This is, market taking notice. The NASDAQ 100 is down 1.5%. That's one of the biggest days down we've seen in quite a while. So if everything's fallen into place the way predicted, why change anything? So therefore, what I'm getting at is, we're still in the trading range, and they still very well could come in and buy it here. There's a massive gap now. Look at how big this gap is. If they want to backfill the gap, they got to go all the way back up here. That's where we closed yesterday. But you also have resistance levels. They were former support. Remember, I had 441.90 as one of my targets. We hit it to the button there, bounce, had a typical reaction. Here's a whipsaw I mentioned the other day, and why that would likely prove to be a whipsaw, rallied right into resistance. So that's it, guys. These are the levels. You can micro trade them or just sit tight. Like I said from day one, if you're a typical swing trader, trend trader, the target for the swing trade was the bottom of the zone. And so if you're willing to ride out the bumps, today will be interesting, because if they can't gobble this up, and if they can't get IEF back into that, well back into the yellow zone, and even then, remember, let me just not forget, IEF, I labeled those zones, these go back months. I modified them on February 29th, so I had put them out well in advance of that. They've been out pretty much all year. I just want to make the point that the yellow zone is still a kind of a danger zone. They're color-coded, yellow, orange, and then red. So it's not like super bullish. It's just kind of near term, more bullish than bearish. But unless we get back in the green zone, and remember, there's a big asterisk there. You don't see it right here, but I've been talking about it forever and a day. There's the potential. So this is why I do these long-winded videos, because everything is not black and white, straightforward. If we happen to do this with treasuries, that's meaning bond prices are going up, meaning yields are falling, but it is because of a flight to safety. There's a massive, this is one of the most crowded long side trades we've had in a while. Many indicators show that, sentiment at highs, fund positioning, and all that other stuff. So if the institutional traders. That's usually who does it. Mom and pop, grandma doesn't typically, I see a correction coming, I'm going to sell my AT&T stock, my dividend stocks, and go into treasuries. No, that's not what happens. It's pension funds, hedge funds, active fund managers that are managing accounts. They'll move into treasuries. So that is the one caveat, if you will. If rates are going down and bonds are rallying, but the stock market's breaking my next and lower supports, the sectors, those key yellow levels I've given you on the top 4 sectors in the S&P 500, on the formerly known as Magnificent Seven stocks, if and as they are taken out, I would push the shorts harder. So again, I just wanted to say that this is net bearish. There's no arguing that if bonds continue to fall, it's because yields are going up, and I can't say nobody, because I've been laying out this potential scenario for a long time, but very few believed that at this point we would see rates continuing to go higher. We already know that the trajectory and dot plot of the rate cuts has substantially changed from where it was, the middle of last year. These rate cuts keep getting pushed back. The chance that the next meeting keeps getting dropping. And anyway, so we'll watch that. And again, keep an eye on it. It's it's just one of many things to watch, including this one. Of course, I'm just kind of recapping what I got out here this morning. Crude oil. Bulls were dismissive of this early on, as evidenced by the stock market kind of shrugging off. And now, as I've said, more and more eyes, and you're hearing more and more folks talk about it. Oh, crude's going up, and they're giving you all the reasons. Oh, well, that's because of strong economic growth, China coming back online, stimulus. It doesn't matter. This is the king of inflation. This is as I referred to it today, the lead sled dog for inflation. Inflation, everything else is going to follow crude oil, and so that's why I'm going to roll into the trade ideas now. So commodities, number one, mentioned you can go with broad-based commodity ETF like DBC. Mentioned that back here recently, and then again on at support, great support, breakout there, and so we are now. As I mentioned a couple of weeks back, we were about on par with what the stock market did from that point when I first highlighted it here. Then there, so now we're certainly outperforming the market, not by a lot, but again, it's this is speaking to the swing trader and investor and trend trader. This is diversification. This trade could peter out and just do this now. You don't put all your eggs in one basket. But the risk reward is just a whole lot more favorable, and we are seeing that those kind of the return of inflation, the sticky inflation. So this is where you want to be right now. Maybe that ends soon. We'll see. Crude's certainly getting stretched. I mean, USO isn't going to go up forever, but right now, can I make a strong case to short it? Yeah, if I wanted to, I could make a case for a pullback here. I just jumped over to the USO 60-minute chart, by the way, guys. I haven't even marked this up. Yeah, you got a divergent high, just like you had one there. But guess what? In an uptrend, divergent highs are typically on the 60-minute chart. They're good for corrections, but they don't necessarily end the run. So we'll watch crude. There's an uptrend line. If it wants to pull back, you could probably even do a secondary, steeper uptrend line there. And those are all potential pullback targets. And here's the thing. Crude could reverse today and close the day. It's up 1% right now. It's coming up on the next, I had this line here for a while. That's not very good resistance. The thing about crude, it's coming up on those peaks back there, the peak it had back in late last year. And even if it pulls back, prices are still going to be in that, if they pull back a little bit, they're still going to be in the yellow zone. And this is inflationary. Again, this is putting crude prices back to where they peaked in 2023. We're very close to that now, and we're not all too far off that 2022 all-time high, which just killed the market. That was peak inflation. Remember, hottest inflation in nearly half a century. So anyway, that's what the market's going to watch and respond to, and it may be tick by tick at this point. That's the whole point of mentioning and laying out these zones where the stock market will become increasingly sensitive to moves up. or down in these in commodities and inflation. Okay, let's go over the other trade ideas. UNG, that one, of course, is split here and messed up, but you can see on the daily, and I mentioned, and if you didn't see it, go back, just come to the bottom. When I published this post, you can go to the bottom of the post. All the symbols covered in any video or any post with screenshots of charts and commentary, there's the tags, symbol tags down below. So if you click on UNG or $NatGas or NG, if I cover the futures, /NG for futures, it'll queue up all the previous commentary in order of most recent. So you can go, and I don't have that chart queued up. It's on stock charts. It shows the long-term chart, natural gas down at pretty much a low end of its long-term range. And so, mentioned as one of my favorites right here a week or so ago. And it's not that big so far, but I just wanted to point out we've just hit T1. Remember, T1 as all targets, these are the actual resistance levels. We may have had a full tag of it, but if that's your target, yeah, we hit a high today of 1572. My T1 was at 1572, close enough for government work, actually perfect. But this thing just broke out, so I don't care to short it here. The next objective long entry would be on a solid break above T1. Great if we get a little pullback or consolidation first, and if we do, then R1. Remember what R1 means: first resistance, about 1485 plus the downtrend line. So any pullback to that level, resistance once broken becomes support. So now I make that R1/S1. Meaning the first support down below, right? Maybe, that guy could add a level right there, 15, 16. Yeah, that's where I wouldn't wait for a pullback all the way to, maybe you get it, great. But yeah, anyways, natural gas, the thing about it, guys, typically when you're long and it's going down and you're on the wrong side of the trade, it doesn't let you out. It just keeps going down, down, down. You don't get those kickback round. Oh, okay, if I just get back, to even, or just get back maybe the first 5% pop, counter trend, I'll get out. And it doesn't let it, and it doesn't let the longs in either when it wants to run. So that's why I call it the widow maker. So if you're on the right side of the trade, very few things other than shitcoin and things like that will put money in your pocket as fast as natural gas. But and then on the flip side, very few things will take money out of your pocket so fast. So what I always say is, don't put your whole account or half your account in there. Beta adjust your position size accordingly. Okay, and then I said also there, best to align UNG with targets on those on NG. Oh, which brings me, that's something I wanted to bring up. Okay, so how I am constantly preaching the benefits of, even if you do not have a futures account, of watching futures and trading, incorporate them into your trading, even if you're an ETF trader, be it QQQ, be it UNG for natural gas or any other commodity, corn, wheat. And look, I don't have affiliations with anybody. I've reached out to partner up with charting platforms. I don't care. I don't need that hassle. I don't need the extra income. I don't want to. So I'm not promoting futures. I want to make that clear. I do trade futures, but I also trade ETFs and ETNs in various accounts, more swing trades and things like that, and trend trades. But the benefit of futures is twofold, multifold. Number one, I like them because they trade around the clock, liquidity, all that, but they will give you a heads up. So just like on that UNG trade, I mentioned, best to align your UNG price targets with those on NG, on natural gas, and I gave you those targets before, because the futures are what matter. The futures are the tail wagging the dog. This is the dog, if you want to say it, and the futures are the tail, because UNG and wheat and corn and all those ETNs, they are tracking and using that's what they're tracking. They don't track spot corn prices. They're tracking they're using the futures to. And there's they're not going to perform as well because they have expenses and fees that the futures don't. But where I'm going is a heads up, and I mentioned that day, and that we broke out here. Was it nat gas or was it something else? Where you had a big gap up, but in the futures you would have got in. Let me get to where I'm going here. So Forever and a day, I've been talking about the waiting for the next sell signal in the stock market, the next down to enter the orange zone, which I showed you we did on IEF today. Here's the thing about how did we enter it. We'll go back to IEF, and this is just another great example. We gap down. This was the 93.43. You can see as I zoom in there, I think you can see this was yesterday's close where these yellow lines are right there, the top of this green candle. And this is the opening. There's a little dotted blue line. You probably can't see it in the video, but that's it. So this was what we did. We gapped down. Okay, two things. If you were long treasuries because you bought support, you had a, you thought treasuries were going to bounce, or the stock market because treasuries would bounce off this support once again, as they did back here. Well, you got burned trading IEF. You were subject to one of the biggest gaps in a while, and I also mentioned, by the way, I didn't remind you. Yes, yeah, I told you that that's typical when you have a false breakout. You get rejected. Once the breakout fails, you quickly go down and then quite often back through the bottom of the range. But again, the takeaway here is that didn't happen until 9:30 a.m. If you trade futures, or even if you don't trade futures, even if you don't trade treasury bonds. Remember, I'm watching this more so for the stock market. I'll show you. I had a price alert on ZN. ZN's a treasury bond futures, and that alert, as you can see here, went off. I got an alert on my phone and email, 6:11 a.m. in the morning, and that ZN took out the same. I had the comparable, the bottom support level, which was 109.79, and so that told me right there we just lost for the first time. We just entered the orange zone, short equities. So you had a heads up at 6 a.m. in the morning. You could have shorted futures. There's plenty of liquidity there. Stock futures, NQ, whatever you're trading. RTY, the small caps are even more sensitive to rates, as I talked about, than the large caps. Or if you're trading treasury bonds, there was your heads up. And I also had an alert to tell me when IEF goes into the yellow zone, but IEF is an ETF. It tracks this 10-year treasury bond. But guess what? It trades at 9:30 to 4. Yeah, it has after, but you're not going to get alerts on pre-market trades. That just the liquidity's not there. They don't. Most platforms won't give them to you, and if they do, they're suspicious because then you can get a trade that's away from the regular price because it's so thinly traded, especially something like IEF. So you can see that happen right after the market opened. It fired off that we went into the yellow zone. So the takeaway now is that you could have. The stock market rolled over slowly. If you go to QQQ, not slowly, but you had plenty of time. Turn on the after-hour trades, and you can see here, if you were waiting for IEF to enter the yellow zone to short or add to your shorts, guess when you got to do it? Right here. If you waited and followed that alert when the futures broke down, it was right here shortly after 6 a.m. And that was it would have got you as an active trader, 1%. You would have made an extra 1%, which was most of the drop so far. Remember, we hit those support levels where I said a reaction's likely early today. This is it. I got that out early in the morning. That's it. That's a reaction. A reaction I define as, we've gone nowhere, but that's exactly what a reaction is. I define it as one of two things, and you can see that on the site. When you hover over the word reaction, it gives you a little pop-up. It's either when you're going down, it's a consolidation. You stop going down and you just stay there. And I use the analogy like dropping a hacky sack or a bag of sand on the floor, or you bounce, and like dropping a golf ball or a tennis ball on the floor. And so far, that's exactly what a reaction is, exactly what I expected. And but again, so the takeaway is, if you shorted the gap, you went nowhere because you missed most of the meat happened in pre-market right there. And here's my ZN, the 10-year treasury bond. So that was the comparable level. That's where my alert was. And so that this is a 2-hour candle, 6-month chart, the long-term chart. But that's the bottom of the zone there. So anywho, and there's that potential divergence. So, point is, it's still not that all-in short moment. It's one down day, but we've had plenty of those. Certainly helps what we see today. And as I said, it will, if this proves to be a whipsaw and we get back up in there, and and we have to do it now, and you can see my lines right here on the potential divergence, potential positive, aka bullish divergence. If we go much lower, if we get rejected or even briefly pop in there and go back down, we're going to burn through or negate the divergences. That means we've taken out these previous lows and we no longer have higher lows. And I call it potential because for me, and this is just something I made up, you got to have a bullish crossover that effectively puts in a higher low above the previous low there on the PPO or MACD. And so that's why, for today, we're having that reaction at that level. I think today and or tomorrow, how we resolve this level is going to be important. If the bulls can, take QQQ, let's forget about QQQ. This is probably the most important thing. Treasury is back up. Them where to? Well, if they can, get back above the bottom of the yellow zone here. Remember, we're still in the orange zone. Then this downtrend line. And if that happens, it's going to give us this bullish wedge right here. So this is why it's still, the shorts are working so far. Remember, the whole point of the short trade was to fade the Fed rally. And as I often say, the initial reaction, which was right here, this whole thing was a Fed reaction. And as I say, that's what I call noise. Like I said, it doesn't guarantee it won't stick, but quite often the initial reaction is not the lasting reaction. As you can see, so far now we have a full 100% fade. This is right here. This is where the FOMC meeting announcement was. And so now we've officially faded all of it, 100%. So that wiped out every bull or every long side trader that bought, and every short that got squeezed out is now saying, darn it, why didn't I, And again, that's why I said take that with a grain of salt. It usually takes, at least a couple days until the beginning of next week, and that's what it was. So, the Fed meeting was on Wednesday. We popped on Thursday. We shorted it because we're at resistance with a divergent high, which increased the odds it was going to fail. And so far, so good. But this is where the party really gets started. And then the odds for my longer term, or even let's just focus on my intermediate term swing target, because I've been chastised lately for even talking about, anything more than a 10% pullback is heresy lately. So these are just your initial swing targets right here. And I've talked about this being kind of the sweet spot right now at this point in time, a pullback to the 200s. But again, those odds, although I think those odds are favorable right now, favorable means anything above 50%, they go from favorable or fair or good to very good if and when 433 gets taken out and those other things I'm looking for. All the better if we remain in the orange zone. And if we get in the red zone on IEF, like I said, to me, I can't give you investment advice. Load up on shorts, strap in and hold on, because that's where the stock market will start to freak out if we get there. Okay, enough on the stock market. My thoughts, the levels, how to, what the plan is. It's kind of a flexible plan, as always. SOXX, semis, remember there's at least three. The three big semi ETFs are SOXX, XSD, and SMH. This one has a big weighting in NVIDIA, and just like NVIDIA and the other ones too, they all put in those bearish engulfing candles back here, divergent high. I mentioned that as another objective, and not just a pullback short-term trade, but a swing trend trade to and give you some initial targets. Again, take you down to the 200-day moving averages somewhere in here, because a bullish engulfing candle after an extended uptrend, exactly as this bearish engulfing candle. No different than the bullish engulfing candle here with positive divergence. Those are have the potential to be trend change. Those are what we call topping and bottoming sticks, and like I said, they're one of my favorite because they don't always work out. I've pointed out some bearish engulfings and some bullish engulfings in the past, and I always will if I see them. And you got to learn when to recognize them. Not early in an uptrend. That's not, if a bearish engulfing comes, ignore it, because they're not. They shift. They're used to indicate trend changes, made to primary trend, not just little corrections and all that. Sometimes you do get that. But again, you don't want to look for them after a major bottom has been put in. That that tends to give you the new trend up, but it could mark a major top. And as such, again, so even if the probability, let's just give it a low probability. I'm just picking a number. Let's say 30% success rate, right? Go with that. It's again, if you look for them in the right time in the right place with other criteria. You have all the makings of a buying climax there, huge surge in volume with a massive spike. You probably can't see it, but that day had a biggest candle that we've had since in over a year there, I think it was. So you had the negative divergence, an extended uptrend, extreme bullishness, so many other supporting facts that put it way above 30%, in my opinion. But let's just go with a 30% success rate. What I love about them is you almost can't lose because the RR is phenomenal. If you shorted it, even if you waited to the very end of the day, I pointed out during the day, intraday, you could have shorted it then because it was almost certain you're going to close. But let's just say you waited right before the close. So you had a 5, about a 5, a little over 5% downside, whatever it was, if stopped out, meaning we took out, give it a little, you can be a little bit above or right at the top, wherever you want. I like to give it a little room. Sometimes I'll try to the algos will try to punch through there to clear the stops. But either way, so 5% downside to, and again, I have to reiterate, these are just initial swing targets, 25% downside. That's a 5-to-1 RR. I'll take that all day long. Go to Vegas, sit down on any game and tell me you're going to get, those kind of odds. Excellent, in my opinion. So, or at least that's the RR. It's not necessarily the odds of playing out, like I said. So, and I just picked that random 30% number, but like I said, that changes. And you can even add a BOD or benefit of the doubt trend line now if you want, something like that. So this sector, I just wanted to mention, still one of, for potential. And it's not, in my opinion, well, let me do a deeper dive into the semis. And I've done, again, you can click on that. And I did a video not too long ago, and I've gone over these charts. A lot of them are rolling over. It's just the beloved NVIDIA kind of holding the sector up when you go through the components. A lot of semis have already topped, put in similar bullish, bearish engulfing candles and or divergent highs, but also gone on to break trend lines and key support. So that's still one I like for a swing/trend trade. A new one that I'll share with you today, IAI, Broker Dealer Index. This are, you have companies in here, including but not limited to, you can see before I leave the charts here, big old negative divergence right here. You can see we had a divergent low right here. Where's my screen tool? Big old divergent low, divergent high, divergent high. This was almost identical here. You had a wedge right there. Divergent high, you broke down, kind of meandered around for a bit, and then the bottom fell out. And that proved to be the bottom. You can see we were diverging, positive, aka bullish divergence there. Pop, there's our trend up. And now we have this beautiful bearish rising wedge pattern and a breakdown. So this is, my friends, an actionable trade. If I would have given it to you yesterday, it would have been a trade setup pending a break of this trend line. Now, we could get a whipsaw. You want to increase your odds, wait for a solid daily close below. If everything snaps back and we rally hard to close on or close enough to the trend line, you have to squint. Well, maybe it'll prove to be a whipsaw. As of now, it's a breakdown. So take it, don't take it, trade it as you want. I don't have target. I'll give you targets because I'm throwing out trade ideas. First stop's going to be if this breakdown sticks about 111.30. I will have to sharpen my pencil. I may revise these targets. I think we'll have a reaction here around 107.65, and then down here. So let's just say right now, this is a sweet spot, 105.37, a little bit above 105.40. So we'll call it 105.50ish right there, and that would also probably be close to the. Let's see the measured target. It's easy to do. Just take a trend line, measure the widest part of the wedge, add that to where the wedge breaks down, and look at that. It never fails to amaze me. I didn't do this before the video. How often my preferred targets line up with that, as well as key Fibonacci ratio. Here, why don't we just keep going for kicks and giggles? Let me throw up some fibs here and just see where the fibs come in. assuming that was a top here. So I'm going to color that up a little different so we can see it real quick. Purple, maybe you can't see that. Make it pink. Look at that. And there it is. And this never fails to amaze me either. 38.2, typical retracement. So as you know, bulls out there are rolling their eyes, 9% drop you're calling for in the brokers. That would just be a run-of-the-mill 38.2% retracement of this move up. And so even if you're longer-term bullish, you know, that would be a pullback target to go long. And if you're a short seller, of course, a target to go short, game a bounce there. And then I'll let you know at the time if we start to approach that level, if I plan to go and stay long, plan to game a bounce and go down, or plan to sit tight because the bottom's about to fall out of everything else. Remember, if we start going down 10%, which even most bulls are calling for right now, yeah, we're overdue, we need a correction. It's going to do things that those that don't really bury themselves in the charts like I do see, and that is the potential to take out some key moving averages, key uptrend lines, those key purple and yellow and purple support levels I've been talking about, maybe roll over some weekly and monthly trend indicators, things like that. So just keep that in mind. And that's why, like I said, I can only assess if and when we get there as to whether we're going to bounce, how far we're going to bounce, if it's just going to, we're going to go to new highs or keep going lower. And you can see here too, look at these 200-day moving averages, the red and the blue lines. They're pointing up now, so they're going to come in around that time right there. They're going to start to roll over, and there's just going to be a confluence of support. So this is a trade idea I like. You can go with the individuals if you want. There's GS, Goldman Sachs, same story. You can see I'm just going to rifle through these quick. Negative, big old divergent high, negative divergence. There's your first target, about 396.70. LPLA already broke down from a beautiful little bearish rising wedge with a divergent high right there. There's your divergence, just like you had right here. Did that. There was a bullish divergent low right there. This is swing trading. Go up, up, up. Look for divergent high, go down. Divergent low, go up. Divergent high, go down. These are all just various components of IAI. CBOE. There's Chicago Board of Options, I believe. And trying to draw this trend line here. There it is. Divergent high. Beautiful little trend line break right here. Sell signal 1. First target's already been hit. I had this level for a while. Once that trend line, you have dual support there at about right here, a little bit below where we were, the recent lows, 179.85. That gets taken out. We go down to 172.16. Then you have the 200-day moving averages. And then ultimately, if things get ugly, then we come on down to this longer-term primary uptrend line, which I think has a good chance of being hit this year. And if so, that's going to be a drop from where we're at now of roughly, depending if and when we get there, about 20%. And I could go on, but they're all telling me, they're singing the same song. Divergent high back there, divergent high right here. This one's still above trend, so this is what I call trade setup. Again, you can go, I started with ETFs. ETFs, I'm pretty sure the majority listening to my voice want the ease, convenience of ETFs. You don't have to worry about navigating earnings like you do on individual stocks or some surprise random news event that can, go against your position. But that's it. So Jefferies, this one just broke down. And so there's an actionable trade. I don't have the targets up, but I can tell you I can see one right here. That's a nice swing target down there, 38.72. So you've got another 11%. Like the rest, 200-day moving averages are going to come in there. So let's just say we're looking at a good 10% or so drop right here on IAI. BGC Group hasn't broken down yet. DFIN right on the trend line right now. That's Donnelly Financial Solutions. And there's a lot of others. You can, go to Interactive Brokers. You can look at that. See this, haven't marked these up. I'm just going to brokers that I know are brokers. You could go to, who else we got? Schwab. Same story. I'm just gonna find these divergent highs everywhere. Birds of a feather flock together. And I can draw a nice clean up trend line there. There's Schwab. Well, that's it. Let's stop there because then I can't get through the rest. IAI is the sector ETF. Just keep it simple for now. And if you are interested, if you do trade individual stocks or options and you want me to go through and find some additional ones. Look, by the way, if Schwab, if we get another up in the market, you can easily see that. I have some price resistance here around just under 76, and it will still be a divergent high if it happens anytime soon. So this one's not an actionable trade. Unless, and there's nothing wrong, I'll do this a lot. Since the sector is breaking down or looks imminent, you can get in front of this one. I like to do that. If I see a breakdown that looks imminent and likely, I'll start taking a starter position and then add to it if and when we get some additional breakdowns. So, trading IAI, obviously you want to pull up all the brokers, look at the biggest ones, and the more check marks you have, the more that have broken support, the higher the probability is that that trade on IAI is going to play out. I mentioned 2 weeks ago, I think it was, the restaurant stocks. I covered a few of them, but not in detail. But this is the ETF. It is thinly traded, but you can, go with a lot of the individual restaurants. I mentioned McDonald's. We already had a great trade on that one back before. Starbucks is in there, but that one not one of my favorites to short. This one's at support. It's already been beat down. It's already rolled off that big divergent high. It's in a downtrend, but the sector's in a downtrend, so you could short it on a break below 89.50 with a stop above this trend line here or this one here. So these would be your two stop points. And if you're a bull, same thing in reverse, where I would stop out as a short if I took it, which would be either above this downtrend line here or above this uptrend line, which broke recently. And then maximum stop right there. That was a big level. I had it color coded because it was important, around $97. We broke it back here, had a brief period above it, but you can see it's been resistance. It was big support back here. So, and again, this is the next support. If that goes 80, basically we're at right now, about 89.50 if that goes. Next stop's $82. So we can round that off for kicks and giggles there. All right, CMG, Chipotle, home with a $10 burrito. I mean, burritos when they first came about, it was a cheap, it was a way to, it was supposed to be a couple bucks, and now we're $10 plus. But whatever, it's good for them. This whole thing, everybody's been jumping on board the whole inflation train. Everyone's got to raise their prices, and they talk about how resilient the consumer is, and they keep eating out and blah blah blah. That's a trade that is ready to, in my opinion, reverse. But there's your levels. You can see we're at price support now, and there's the uptrend line. A lot of room to fall. I don't have targets marked up, but I'll give you one right now if you're interested in Chipotle. Right there, 23.55. Again, I could go through them all. You're going to see birds of a feather, a lot of divergent highs, many already breaking down, some that haven't, but more downside in the sector to come. And again, EATZ, if you don't use a broker like Interactive Brokers, they have the best availability of shares to short. And again, I have no affiliation. I'm just telling you that because I get these comments. If you're using Schwab or Fidelity, a lot of these more thinly traded ETFs and stocks, they don't have available to short. In fact, I can tell you right now, I can type in on EATZ. I have to go to another monitor and tell you. Interactive Brokers, yes, they have, they're green lighted. They have at least 4,884 shares available at least to short with a fee rate of 7.6%. Tells me that if I type in the ticker, and then you have to have that column, the shortable column up on your IB trader workstation. Bump me if you have any questions on how to do that. It's very, very handy. I like to do that too, because if I'm going to short a stock, I like to know, because IB, if it's dark green barred, if I'm in a position, all of a sudden it goes from light green to dark green, or especially to red. Red's the worst. They have no shares, and I said don't even bother. Dark green means we don't have any right now, but we might be able to get some soon. But it tells me then they're getting high short interest, and then that's when I don't like to really. I'm not comfortable to be in those heavily shorted stocks. So sometimes I'll look to close out my position if the charts are concerning me. PEJ, I mentioned this one. It's kind of on the same vein of the restaurants. This is leisure and entertainment. and just a beautiful bearish rising wedge. We're starting to crack today, but I'm going to move it. I'm going to just tweak my trend line and tell you we're right on it. This one has a little more liquidity. You can tell these are more normal looking candles than EATZ. Targets right there. First, a minimum target 40, just above 43.33. And you know, if we get some traction, like a lot of things, are probably going to come back test their 200-day moving averages soon. Again, there's some work to be done. Oh, and one more sector for you: home builders, ITB. Beautiful, big old divergent high, or XHB. I think XHB has a little more volume in it, a little more liquidity. Look at that beautiful bearish rising wedge, divergent high. Just duplicate that, wash, rinse, repeat. We shorted them back here last year, milked it down. Believe it was ITB. I might have been proxy, or the individual builders I was using, but just a nice clean. Look at that extended uptrend line. Solid red candle today. That is actionable right now, and I already gave you a target if you want to, you know, go for the quick stop. And remember, guys, on all of these sectors, these are sectors that are in the market. They're in the S&P 500. A lot of these companies that I just went over, whether it's McDonald's, Chipotle, these home builders, and so the odds will go up substantially. That these are going to play out, especially to the deeper targets I've given you. This one, I'd be looking at this $91. I think it's a great, actually, right now, let's say 91 would be my preferred target. I'm going to round that up, make it a round number. And this is my, if things get uglier, target right here, 85.15. But so my preferred swing target as of today, that's a 15, almost 16% drop. There it is, guys. Plenty of trade ideas right now. So, you know, we want to keep it super simple. Short the equities. I favor the Qs, which is NASDAQ 100, and or the small caps. I like a little of both because small caps are rate sensitive. I haven't done an update there in a while. IWM, this is a daily chart. Remember, this was big level here. About 208.50 was the top of the top. This was a big topping pattern back in 2020, all the way from late 2020 into the beginning of 2022 when it broke down. It was great support right there. We had a failed breakout with a big old divergent high, broke down, we back tested it, rejected multiple times. Now we're back to that again, and we had a beautiful little bearish rising wedge. You can see it on the 60 as well. Complete with divergence. We had like so many things, what I call the post FOMC whipsaw right there. There was a lot of noise around the FOMC meeting, but we are below the trend line after taking out a divergent high right there. So that's it, guys. Let me get it out to you. And I don't know, it's a pretty good amount of trade ideas, and diversified too. Remember, you get the commodities, you can be in bonds. Crypto, I already said before, will ebb and flow with the stock market. So to be long and bullish the stock market is to be long and bullish crypto, and to be short and bearish the stock market is to be short crypto. BTC, this is crypto right here. Bitcoin, bearish rising wedge was the top so far. Went down, broke down from the wedge, had a kickback rally, put in another divergent high right here, been moving lower since, and there's that trend line I said would be the next likely target if this level went, which it did. That was 68,800-ish. Covered that in a recent video, so that's probably a little more downside here, at least in the near term. And if that trend line goes, that's a more significant level. Be ideal to get a reaction off there to help validate it, another reaction, remember, that comes off back here. And then breakdown would take you down here, here, and possibly all the way down here. And this is probably right here, this 60,720. Probably, I haven't looked, will probably align or coincide with the bottom of my the trading range on QQQ that I've given you. And that key, I think it's 433 level on QQQ. So, and therefore my expectation will be the same. Probably get a reaction there initially, but then if and when that goes, that's going to be more bearish and give you more downside. All right, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.